The section I covered contains 1.250.020 former partners and professional employees' participation in a firm-sponsored plan. And this section just talks about if a partner or employee of an accounting firm leaves to work for that firm's client and works in a key position, then there's specific criteria that's listed later on that must be met in order to participate in a firm-sponsored plan. It also contained 1.255.010 depository accounts. And this section gives criteria for an individual or a firm to maintain a depository account at a bank that is a client of the firm while remaining independent. It also contained 1.255.020 brokerage and other accounts. And then this section is pretty similar to the depository accounts. It just gives criteria for an individual or a firm to use financial services such as insurance, advising, or banking done by a client without causing any impairment of independence. The biggest takeaway for my section are the rules that are listed for remaining independent. For depository accounts, the rules are it states that if when a covered member is an individual, the threat would be at an acceptable level and independence would not be impaired as long as there are three criteria met. The criteria are the balance in a depository account is fully insured by the appropriate state or federal government deposit insurance agencies or by any other insurer, or any uninsured amounts in the aggregate were not material to the covered member's net worth, or if uninsured amounts were considered material, any uninsured amounts in the aggregate are reduced to an immaterial amount no later than 30 days from the date that the uninsured amount becomes material to the covered member's net worth. And then for the brokerage and other accounts section, there has to be a couple safeguards that are met to remain independent, and those are the attest client's services were rendered under the attest client's normal terms, procedures, and requirements, and any covered member's assets subject to the risk of loss are immaterial to the covered member's net worth. So the most obvious AICPA principle that this section is related to is objectivity and independence. It's literally just lists of rules to remain independent. And then I also thought it related to integrity, because the rules listed are pretty easy to abide by as long as you contain integrity and act with strong moral values. The two class concepts that I thought it was most related to are one of the big ones. Rules exist for a reason, and then the invisible hand. If the rules exist for a reason, when auditing a client that deals with someone's personal financials or investments, it seems pretty tempting to not report the bank or the client's financials correctly if it's going to hurt their own financial position. So those rules are obviously in place to decrease the threat of this happening. And then the invisible hand, when these rules are abided by, the audit firm's client sees a gain because they keep their customer and they're able to be audited correctly and by an independent firm. And then the accounting firm with the client gets to keep their client and maintain a good reputation. And also the customer of a bank or anything, the individual that is abiding by these rules to remain independent, is able to keep their money basically in a bank instead of having to move it or move their investments or anything.